Hey, it's Doug with New American Funding. I got a lot of questions about buydowns, what they mean, so we're going to try and unpack that just a little bit on this video from clients and from agents. So in a nutshell, basically buying the rate down means paying some money either by yourself or from the seller to buy the rate down, buy the rate to a lower amount for a lower monthly payment. There's several types of buydowns. There's a 1-0 buydown, a 1-1 buydown, 2-1 buydown, 3-2-1 buydown. Basically, they all do the same thing, but there's different ways to apply them. I'm going to cover the most popular one these days, which is the 2-1 buydown. So, and how that applies to, say, a permanent buydown, where you're buying the rate down permanently. So for the life of the loan, you're buying the rate down to some lower amount. Whereas a 2-1 buydown, it's more of a temporary buydown. Buys it down 2% the first year and 1% the second year, hence the name 2-1. If it was a 3-2-1, it'd be 3%, 2%, 1%. So whatever that start rate may be, 6%, 7%, 5%, the rate you're buying it down is 2% lower than that start rate. And you qualify on that start rate. You don't qualify on the lower interest rate. So really there's probably two types of clients that are weighing a buy-down option. You could have a permanent buy-down, and that's more applicable to maybe some qualifying issues. Maybe you found a house you like for $550, you qualify for that, and then you found a way better house for $600, but you just can't quite qualify for that mortgage payment. Maybe we can get some money from the seller to permanently buy down the interest rate, driving down your monthly mortgage payment so that you can qualify for that higher priced house. Or if interest rates are in a rising environment, you may need to go the buy down rate to get a lower interest rate to qualify for the house. If you have no real issues qualifying, you have good income, etc., and qualify for the higher interest rate, you could do a temporary buy down to help alleviate the monthly cash flow. Say you have a bunch of expenses upcoming in this following year and you need to keep your cash flow low. So that's what I've done here with this example. I kind of illustrated both the permanent buy down and the 2-1 buy down. And we take, let's say it's, see right now it's late February. Interest rates are about 6.875 for this example that I've used here. And I'm using a $600,000 house purchase with 10% down. So the first column I have is market rate, 6.875. You can see the mortgage payment there. I'm just estimating taxes and insurance and mortgage insurance as well. And the next column over is a permanent buy down, where we're using some money from the seller, in this case 3% or $18,000 from the seller to buy the interest rate down. And it's a permanent buy down, so the life of the loan, the interest rate is fixed. The next column over is a 2-1 buy down. It's a temporary buy down, like I said before. So with $18,000 from the seller, we're able to buy that down a little more. Your start rate's into the 4s. And then the next year it goes to in the 5s, and the next year it's up to 6. I think I use 6.625 for the final rate. So the start rate's 4.625, and you can see the payment's much lower. So again, the temporary buy down, you still have to qualify at the higher payment, but the payment's a lot lower that first year, and that second year it's lower as well. Third year is when it comes up. And then the fourth column over, I used like what does it take for a price reduction to match that payment of the 2-1 buy down? And you can see it's a pretty significant price reduction on that house. So it really helps your buying power as far as a monthly cash flow. Going deeper into that, if you refinance, say, in a year, that money that we set aside for that temporary buy down is just sitting in an escrow account to help make your mortgage payments every month. When you do refinance, that money that's in that escrow account goes to help with principal reduction. That's pretty much all it can use. And so with current environment, we do anticipate rates to drop over the next 12 to 14 months, at which time it's a good time to do a permanent refinance, lock in a lower rate for a 30-year fix, not do a buy down on the refinance or anything like that. So for the next 12 to 14 months, you have much more flexible monthly cash flow and hopefully a little more peace of mind moving forward about buying a house in today's market. So hope that answers your questions. Once again, it's Doug deBruyn, New American Funding. If you, friends, family, coworkers have any questions about buying, selling, or refinancing real estate, please just drop me a line. My contact information is below. Hope you found this useful. Thanks.